Hi there, Serial Trader here. So, interesting day on the US indices, US markets overall. Quite a bullish day, although it's not surprising. So, on Friday, I mentioned that the overall market was very oversold on multiple time frames, and a strong bounce could occur basically anytime. And the market didn't waste any time to make that happen. It opened higher today and then had some extremely strong upward action basically throughout the day. There were a few little pullbacks here and there, but broadly speaking, very strong day. So that's interesting. So that 200-day moving average on SPX held nicely, as did the 78.6% retracement of this partial move up. Okay, and then we were discussing that potential bullish Elliott wave count on Friday, where this would actually be a wave one up, an ABC down for a wave two expanded flat, and then possibly a wave three in progress, new highs, and then this initial leg was actually the entire correction. Still not necessarily convinced that that's the case yet, but we're certainly off to a strong start. But you'll notice we're still below the T line, so we'll certainly have to start getting above that on a closing basis to at least start entertaining that this is more than just an oversold bounce. Anyways, I thought today I'd actually touch on my own personal strategy, or how I'm trading this particular market. So you can trade SPX options. They are equity options and they're cash settled only, and they're European style, meaning that there's no exercise or assignment until the expiration date. So that's a little different from what most people are used to. Most people are used to American style options, which can be exercised and assigned anytime up to and including expiration, and they're actually settled in stock. Each contract represents 100 shares of stock. They're not cash settled like these ones. So, and also these ones have a much larger size per contract. Capital requirement is 10 times that of SPY, for instance. So you can almost equate here, one SPX contract is equivalent to 10 SPY contracts, okay? And that's calls or puts, along with the other differences I mentioned. So let's switch over to the SPY chart. Okay, so that's SPY. Now, as you see, it's basically a mirror image of SPX. It's the closest thing you're getting to actually trading the underlying S&P 500 itself, because this is an ETF consisting of a near perfectly balanced portfolio of all the things that are actually in the S&P 500 and weighted correctly, etc. So this is as close as you're going to get as far as trading the underlying index. Now, SPY also has options, and that is what I've been playing this market with. So again, you can see it just hit the 200-day moving average, so basically a mirror image of SPX. Let's bring up something I haven't shown yet. Okay, so what is this? This is a profit or loss graph for my option positions that I currently have on with SPY. And okay, this vertical axis, that shows you your profit or loss. So this is the zero line. So anything above the zero line is how much profit you have. Anything below the zero line is how much loss you have. And then this horizontal axis is just the actual underlying price of SPY. And it's in increments of 10, so 240, 250, 260, etc. And then you have this purple line. And the purple line is basically at any given price. So as I move horizontally, I'm changing whatever the underlying price is. What is the profit or loss resulting from that with all these option positions in play? And then this teal line is exactly the same thing except at expiration. So the purple line is right now as of today's date, and tomorrow it'll be as of tomorrow's date, okay, et cetera, et cetera. And the teal one is at expiration, which is quite far away. It's in July. So as you can imagine, every day that ticks by, this purple line should theoretically get a little bit closer to the teal line until they're basically in the same place. At expiration, they will be. And now this is all based on reasonable calculations using the Black-Scholes model, okay? And the Black-Scholes model, you know, won a Nobel Prize. It's for pricing options. So it may not perfectly reflect, but it'll be very, very close under most market conditions. Now, if there's a huge change in implied volatility, in this case, it would actually benefit me because I'm net long Vega, okay? And Vega is one of the Greeks. And Vega simply states, okay, so for a 1% change in implied volatility, how much impact will that have on your position's profit or loss? And that's displayed as a number, and it's called Vega. Anyways, not to go down that garden path too far just yet, perhaps in another video, but what I'm getting at is the position I've created is actually a combination of option positions. So there's actually, I believe 6 different contracts. Yes, 6 different contracts here in various quantities to achieve this overall profile, okay? So maybe I'll break it down by the individual positions and then go back to the full position. All right. Okay, so what I actually have, okay, I am displaying one of the positions. It's called a put ratio backspread, okay? What does that mean? Sounds fancy. Well, it's not that fancy. It's simple enough to explain. So it means that you've sold a smaller number of puts at a higher strike price and bought a larger number of puts at a lower strike price. So why would you want to do something like that? Well, I'll explain. So the S&P 500, SPY, I'm entertaining the possibility that it's just going to tank and we're going to go into a bear market, although I'm not overly confident that that's what's going to happen. But I don't need to be in this case. So what I've done here is I've sold 20 puts, SPY July 2018 expiry, 260 strike, okay? Sold 20 of those, and I bought 50 240 strike puts, same expiration date. So I'm long 30 more puts than I'm short. So as the price drops, yes, these 260s will be losing more and more and more, but these 240s will be gaining faster because there's 30 more of them, okay? And obviously, if you know, the farther past 240 you go, you just keep going, keep going. You can see by these profit or loss lines. So at expiration, there's actually a larger range where you could lose more. But right now, and certainly leading up to expiration, and these won't decay for quite some time, the majority of options decay takes place, you know, closer to expiration, not farther away from it. So as you can see right now, the lower we go, the higher this profit graph goes, okay? Pretty linear there. Now, what if I'm totally wrong, okay? And this thing just takes off and makes new all-time highs in the next 2 weeks, and oh geez, I totally miscalculated. Well, not really, because in this case, it does really no harm to you, as you can see. And the reason for that is anything above 260 and those contracts you sold short are worthless. So there's no damage being done to you whatsoever. You're not on the hook. And yeah, the ones you bought are also worthless, but the thing is, you got so much more money for selling the ones that were closer to the money at the time, even though there's less of them, that they essentially paid for the ones you bought, even though there's more of them. So if it just goes up and you're completely wrong, it's like it's a wash. Nothing bad happens to you. So a back spread, in this case a put back spread, extremely attractive, and you can still be wrong and not really get hurt by it. There's just a very unusual range they would have to stay in, and you would actually have to sit on it all the way to expiration to actually have any kind of substantial loss. And you know, you just wouldn't do that. You'd take follow-up action or whatever. Anyway, very attractive position. Not the most widely known one, at least not by you know, beginning options traders, but highly recommend you check it out. Back spreads. Okay, now what else did I do? Well, I also am entertaining the possibility that the S&P 500 is just going to go super bullish and resume its uptrend that it's been in for quite some time. So I bought 30 out of the money calls at the 276 strike, expiring in July. And now I've added that position onto this overall profile, and this is what we have. So now, as you can see, I can start making an extremely large amount of money very quickly to the upside as well, not just the downside. And as you can see, that purple line represents where I'm really not going to lose anything no matter where it goes right now. It's just the real risk comes closer to or at expiration. But that's, again, if you didn't take any follow-up action, and there's lots of time to expiration. So don't worry too much about that. But what else did I do? Well, I also had another position before. I was actually long a strangle, okay? And those are the two contracts types I was long there. So I was long 10 of the June 276 puts, and I was long 10 of the June 265 calls. So that's a strangle. And at one point I took follow-up action and sold 10 puts short at a lower strike price to the puts I was long. So we'll add that on as well. So this is my overall SPY position with options. 6 different contracts, okay? And really, extremely attractive, especially before expiration, you know, leading up to expiration. It almost can't lose, or it can only lose a tiny amount of money or be, you know, slightly underwater, okay? And if it goes up, well, you know, you can see that, you know, you're at $100,000 with SPY at just over 300, and you could definitely see that if the bullish scenario plays out long before July. And, you know, we're at $100,000 over here if you hit, you know, 190 on SPY. And certainly if we go bearish, 190 can come pretty quick long before July. So you can see this is an extremely attractive overall position. Has some complexity to it, no doubt about it. And nothing to say I won't make some adjustments. I mean, if we go up 200 points on the S&P, which would be about 20 strikes on SPY, I'm not going to hold this to July. I'm just going to close it, and you know, I'm going to take my where are we right now, 265. So if we go to 285, say, I'm going to take my $40,000 and say thank you and move on to the next trade, whatever. And you know, same if we tank and go to 220 or something, I'll exit and take my money. But this just still visually depicts what will happen at expiration under a variety of underlying prices, okay? So it's a very useful thing to look at. A lot of people that trade options don't look at these graphs, and you should look at them before, during, and after you close the trade. They're extremely useful, and they just give you a great visual depiction of what you should really expect with your position and whether you actually put on the right position, because sometimes you don't realize what your position will do under these market conditions, okay? We can probably do some more work on this on a different video, but I don't want to go on too long. So yeah, basically, just to summarize, nice bounce, not confirmed yet whether it's just a bounce or something more. And I'll leave with one goodie, okay? One goodie on this one. So GBTC, okay, that is the Bitcoin Investment Trust. If you want to play Bitcoin on the regular stock market, this is a good proxy for it. It typically trades at a premium to the Bitcoin that it supposedly holds for you, but basically moves up and down fairly reliably with the price of Bitcoin. And right now, we're just about at the 200-day moving average, and if you saw my BTC video, Bitcoin's looking extremely good for a bullish setup, so that means this is as well. And if you look at the last time GBTC hit its 200-day moving average, well, that was an extremely nice buying opportunity. You went from 9 and change to, you know, over 20, so you doubled there, more than doubled. So if that repeats, which it could more than repeat if Bitcoin's going where I suspect it might be, nice risk reward here. And you know, if you get in and you want to stop, put your stop below this previous low here. So it's still, for this kind of thing that can double or triple quickly, you still have a pretty tight stop. Oh, and one last little thing to throw in there before I shut the video down. So the VIX, again, we made a lower high on VIX on Friday, and that remained a lower high, and now we're cooling back off again. So that's based on VIX, that's showing some signs that, hey, maybe we made a hard bottom on Friday and a higher low on that overall chart, and we're just going to take off. We will see. All right, Serial Trader signing off.